At the heart of the crisis was a rapidly expanding housing market.
But in 2008, that system came dangerously close to collapse.
At the heart of the crisis was a rapidly expanding housing market.
For years, home prices across the United States kept rising rapidly.
Millions believed housing prices would never fall.
Banks across America were issuing mortgages at an extraordinary pace. Blanchard finished saying, even borrowers with weak credit could easily obtain home loans. Many of these loans were classified as subprime mortgages.
Wall Street transformed mortgages into complex financial securities.
These securities were sold to investors across the global market.
Investors believed these mortgage securities were safe investments.
Many securities even received the highest credit ratings.
But by 2007, the housing boom was slowing. Homeowners across the country began missing mortgage payments.
The housing bubble that fueled the system was beginning to burst.
Across America, foreclosure signs began appearing on thousands of homes.
Many families could no longer afford the mortgages they had taken.
As defaults increased, housing prices began falling rapidly. The losses soon spread from homeowners into major banks.
Mortgage securities across Wall Street were losing billions in value.
Across Wall Street, confidence in mortgage securities was rapidly disappearing. Banks realized their balance sheets were exposed to enormous losses. One of the first major victims was the investment bank Bear Stearns.
By March 2008, the firm was on the brink of collapse.
Authorities intervened quickly to prevent wider financial panic.
But rescuing one bank did not solve the deeper problems.
Throughout 2008, the financial system remained dangerously fragile. Investors around the world were losing confidence in Wall Street.
Several large financial institutions were now facing severe pressure.
Among them stood Lehman Brothers, one of Wall Street's oldest banks.
Lehman Brothers had survived for more than 150 years.
But in 2008, its balance sheet was collapsing.
The bank held enormous exposure to mortgage securities.
As losses mounted, investors began losing confidence. Behind the scenes, officials were racing to find a solution.
Throughout the weekend, negotiations continued behind closed doors.
Officials feared the collapse could trigger global financial panic.
But no buyer was willing to rescue the struggling bank.
On September 15, 2008, the decision was made.
Lehman Brothers officially filed for bankruptcy.
Within hours, financial markets across the world began reacting.
Stock markets plunged as investors rushed to sell assets.
Banks suddenly stopped trusting each other in lending markets.
Credit markets began freezing across the global financial system.
For the first time, the entire system seemed at risk. Financial institutions across America were now facing severe liquidity shortages.
Banks became unwilling to lend money, even to each other.
Another financial giant, AIG, was suddenly close to collapse. All yours.
Officials feared a chain reaction could destroy the entire system.
The United States government prepared an unprecedented rescue plan.
Thus, the collapse of AIG threatened to destabilize the entire financial system.
Officials concluded that allowing AIG to fail was too dangerous.
The Federal Reserve announced an emergency rescue loan for AIG.
The rescue aimed to prevent a catastrophic chain reaction.
But an even larger rescue plan was already being prepared.
In Washington, lawmakers began debating an unprecedented rescue plan.
The proposal was known as the Troubled Asset Relief Program.
The plan authorized hundreds of billions to stabilize banks.
Markets watched closely as the government debated intervention.
Eventually, the United States approved a massive financial rescue.
Across America, millions of families were losing their homes. Businesses closed and unemployment began rising rapidly.
Financial markets struggled to regain stability.
The crisis forced governments to reconsider financial regulation. The events of 2008 changed global finance forever.
In the years that followed, governments began rewriting financial rules. Banks were required to hold more capital against potential losses.
Central banks adopted new tools to prevent future financial collapse.
But the memory of 2008 still shapes global markets. The crisis revealed how fragile the modern financial system can be. For many, the crisis of 2008 changed how finance is understood.
Risk, once ignored, became central to every financial decision. Governments, governments strengthened oversight to prevent another collapse.
Yet the events of 2008 remain a lasting warning.
A reminder that the global financial system can still be fragile.